Well, the bond market, as we've been talking about, signaling the Fed's next move will be rate cuts. Despite this, though, and ongoing trade war uncertainty, our next guess is the economy does remain strong, or at least strong enough. Joining us now is Ryan Detrick, LPL Financial Senior Market Strategist. Ryan, it's good to see you, as always, here. Why do you remain at least relatively sanguine here? You've got a 3,000 fair value target on the S&P 500.
Well, first off, thanks for having me back, and happy Friday, everybody.
And
but you're right. You know, we just had the worst May in about 10 years. Now we're looking at maybe the best June in about 20 years for the S&P 500. So this choppiness happens. But what do we really know? Well, the economy, in our opinion, at LPL Research, is still pretty good, right? Look at the consumer confidence jump that we just saw. Small business confidence jump just came in. Today's retail sales numbers weren't too bad. And the big thing, what's going to drive this is a 10-year economic cycle, right? We're tied for the longest economic cycle of growth in our country's history right now. We're probably going to break it this summer. It's capital expenditures, companies investing in themselves. We've got a 7-month high in capital expenditures expected out of U.S. companies. So there are really, I get it, there's some negatives out there. But the positives are still there. The underlying fundamentals are still strong, and that's why we think, 3,000 is our fair value. We think this bull market is alive and well.
Hey, Ryan, Brian Chung here. So that sounds like a pretty good thesis. So if that's the case, why should the Fed cut rates at this moment?
Yeah, well, obviously that's a great question because you got the S&P about 2% from all-time highs. You got the bond market begging for a rate cut. Our stance is we probably don't see a rate cut next week at the Fed meeting, but the Fed's probably going to put that ball on the tee for potentially a rate cut in July. And the bottom line, though, is you look back in market history, the Fed has cut rates, surprisingly, I thought, when the S&P 500 is actually close to all-time highs. It happened in 95, it happened in 96. Those times were when the stock market was doing well, but the economy really was deteriorating a little bit. And what also happened, there was a surprise cut, or there's a cut, I guess we'll call it, in 98, when we had the Russian contagion and long-term capital management fell apart. So you can get these cuts when the economy's okay if there's external concerns. And clearly the trade stuff is an external concern right now. So that's why we potentially will probably see a cut in July. But we're the camp, we might just get one cut and the economy can keep expanding. And we still think we're going to have a resolution with China by the fall. There's just too much for each side to lose. Clearly, it's taken longer than we expected. But still, we think there's still time, and 3,000 still makes sense to us on the S&P when all is said and done.
Although, to be fair, that's not that big of an upside from where we are at the moment, right? You also are looking around the globe for signs of slowing. And when you say when you're looking at various global stock markets, at least, they don't seem to be rolling over either. But doesn't that also just have to do with kind of the Fed and its ripple effect?
Well, I mean, I'm not sure how much the Fed truly affects Greece, right? You look at the country of Greece, I mean, that's breaking out to new 52-week highs. Australia is making new highs. There's just a lot of strength all around the globe. Argentina, Brazil. It's really unique how there's different countries that really don't seem that interlinked that are making new highs, new all-time highs, new 52-week highs. In my opinion, or our opinion at LPL Research, you're probably not going to have a global recession if Australia and Greece are both breaking out the highs here. That's a sign that, yeah, we can have a little bit of a slowdown. But what you tend to see ahead of recessions is obviously various markets peaking out. You get a little geeky here, advanced decline lines, how many stocks going up versus how many stocks going down. Keep this real simple. The NYSE advanced decline line just made a new high earlier this week. That's a sign of a lot of participation, a lot of stocks that are going up in this move. Think about it like this. In 1999, everything was going up. But really, the only thing going up was technology stocks. A lot of other stocks were breaking down under the surface. We just don't see that right here. So fundamentally, the economy looks pretty good. And technically, there's a lot of participation, especially globally. And that, again, suggests that, hey, the opportunities are there, and the global economy will not have a recession this year, probably at least for the next 12 to 18 months, in our opinion. And the U.S. definitely isn't going to have a recession, in our opinion, over the next 12 months.
All right, a little dose of bullishness here for you Friday. Thanks, Ryan. Ryan Detrick, LPL Financial Senior Market Strategist.